So, hello everybody. This one is going to be called Kai-Zen Mythbusting. And we're going to focus today on the loan. There is so much, look, it's great that everybody feels the need to comment on Kai-Zen. And it's great that everybody wants to talk about it. That's good. But what we are hearing is a bunch of stuff that's just incorrect. So we want to make sure that you understand what the loan is and what it isn't. So let's start, first of all, why you want to consider leverage. The whole point about Kai-Zen is we're focusing on increasing the amount of capital at play so that you can achieve your objectives. We'll cover that in another Myth Bust episode. So let's focus on the specifics of the loan and what's different about it. Let's think of an analogy that everybody can relate to, which is a house mortgage. When you buy a house, most people use a mortgage to buy a better house than they could have done if they just used cash. But they come with some conditions, right? You live in the house, you enjoy the benefits of the house. If the house grows in value, you enjoy that benefit too. But as long as you follow the mortgage rules, which is you've got to make your payments, you've got to qualify for a loan, you've got to be underwritten, financial background checks, all those good things are done. Absolutely none of that applies in Kai-Zen. And we have to say that multiple times because people keep going, it's premium finance, it's a loan, it's a this, it's a that. So in Kai-Zen, what happens? You make 5 payments. Why 5 payments? I'll cover in a bit. You don't have to complete the payments. If you don't, the bank will pull out, right? So the policy secures the loan, but you have no credit checks done on you. You don't make any interest payments on this loan, and you have no personal guarantees on this loan. And you don't sign any loan documents. The bank has no legal connection to you at all. The policy is the sole and only security for the loan. So here's the myth, right? The myth is you are fully being underwritten, that your credit is whether you get the loan renewed along the journey, down to your credit. If it's in bad times and your credit's bad, you won't qualify for the loan. That the bank has control of the policy. Those sorts of things are being talked about, and they're just, frankly, ill-informed. So, I've already covered about financial background checks. That does not apply here. Now, you still have to apply for the life insurance, and you still have to qualify for the coverage. But that's the same with any insurance. It's got nothing to do with Kai-Zen. But you have no credit checks done on you at all. Control. The bank has a collateral assignment on the policy. It's like a mortgage in that regard, in that as long as you cover the payments, those 5 payments, the bank will continue to fund the policy. Basically, the only way they're going to pull out is you default, i.e. don't make one of your payments, or the life insurance company ceases to be creditworthy. They're all highly rated. They're big life insurance companies. I think that's a pretty low risk. So all that means is they're entitled to take their money out if you trigger a default condition. The policy is owned by a trust that you control. So all the control, whether you make a claim, whether you want to pay off the loan, which you can do at any time, by the way, that is all down to you, and all the benefits and growth of the policy outside of repaying the loan is yours. So this is no different in terms of collateral assignment. They do not control the policy. That's called an absolute assignment. It's collateral assignment just like with the mortgage on your house. As long as you make the payments on your house, you're good. Same here. Another myth. The bank can pull out whenever they want to. So these loan terms, again, it's secured loans, right? The bank is really underwriting the credit positions of the life insurance company more than anything else. These loans are typically 3 to 5 years. So there's a contract between the trust and the bank, not you. Unless you default, i.e. don't make one of those payments, the bank can only pull out if the life insurance company ceases to be creditworthy. So that there's really not a lot for them to pull out for unless you trigger it. At the end of the loan term, which is typically 3 to 5 years, the bank renews the loan or doesn't. Now, One of the things you need to know or understand about IULs or any fixed life insurance product is the cash value, the cash surrender value, is equivalent to cash. So this is as good as it gets for security of a loan, which is why we continued to fund through the last banking crisis. So it doesn't matter what happens to your credit along the journey. As long as you're able to make those payments, you're good. Next point is we have multiple banks. So if Bank A goes out of business, doesn't want to continue in this market, whatever happens, we have multiple other banks that the trustee can refinance at any time without any additional cost to you. Now, last point here. This isn't something we've just started yesterday. NIW has been doing this since 2000. We have a very long history with multiple banks in the United States. That's involved billions of dollars of lending. Last time I checked, it was just under $6 billion of loan facility, where the banks in our 22-year history have not lost a penny. So their comfort level in what we do is extraordinarily high, which is why we could continue to lend through the banking crisis. So the myth is that you're underwritten for a loan, it's all down to your creditworthiness, and the bank has control. The reality is you're not underwritten for a loan. The bank only has a collateral assignment, no more than the ability to recover their money, and the relationship is a long-standing position with all the banks that we work with.